Hello there, welcome to another live webinar with me, Sri from Phillip Futures. With us today in the studio is Richard Shi from Legend R Financial Group Private Limited. He's the director for the research department there. More on him later, but today we will be discussing the real-world applications of the VIX and Mini VIX futures, and Richard will be walking us through real examples of how fund managers invest, hedge, and speculate using VIX and the Mini VIX futures. As you probably know by now, or if you have attended our previous two webinars, you will be well aware of the VIX and how it's popularly known as the Volatility Index. So another key point that Richard will be covering today is volatility as a tradable asset class. All right. Richard is, as I've touched on earlier, he's the director for the research department for Legend R Financial Group Limited. In LAFG, for short, Richard leads a team of quantitative researchers from different backgrounds to build an innovative research platform that makes the research process more streamlined, productive, adaptive, and intelligent. So he's very much a research guy. So if you have any technical questions, he is definitely the right person and more than willing to address it. And Richard is very well traveled. He's prior to LAFG, he has worked at HSBC, Rabobank, All Options, and LT Securities Limited. Richard, if you are all set up, I can hand over the rights of sharing your slides very shortly. Richard?
Hi everyone, this is Richard.
Hey Richard, I'm just going to give you the sharing rights right now. You should see a prompt on your screen.
Yeah.
All right, while Richard is setting up, can I just do a quick sound check if you can hear us clearly? Please type yes into the question box. The question box is located somewhere at the bottom of your control panel. So just type yes into the question box. Yes, thank you so much, Ben, Mabel, Woon, and Richard. Thank you so much. All right, I now hand you over to Richard, and you will be in very good hands as he discusses the VIX and Mini VIX futures. Richard, over to you.
Okay. Good evening, everyone. My name is Richard, and I am the Director of Research at Legend R Financial Holdings. Thanks, Phillip Futures and SIBO for having me here. The topic today is real-world applications of VIX and VIX futures, Mini VIX futures. Before going into details of the presentation, I'd like to take this opportunity to briefly introduce the company. Legend R started this journey as a proprietary trading firm. After gaining a solid position in the world of trading, we gradually expanded our business into many other areas, including consultancy, asset management, financial education, fintech, and R&D. Our fully owned asset management company, SmartWise Advisors, is licensed in Hong Kong to conduct Type 4, 5, and 9 activities. In addition, it managed to get the QFIA license to access China onshore market late last year. In short, we are well positioned to access global markets with an edge in combining China onshore and offshore asset management and investment advisory. So now the contents for today. So in the coming 40 or so minutes, we are going to cover these three main areas today. The VIX Index. What's VIX Index? What information does it carry? What's its relationship with the S&P 500 index? Then the products. We will be talking about the products and the indices that are based directly or indirectly on the VIX Index. The last one is the applications. We will go through several use cases of the products that are mentioned about in the product section. Okay, what is VIX Index? I think most of you have at least some concept of what is the index about. The VIX Index represents a 30-day volatility of S&P 500 index from the time of its reading gets updated. So if I go to the Bloomberg terminal now and find out that the current VIX index level is 24, it means that the market participants think the S&P 500 index is going to move at an annualized volatility of 24% or 1.5% each day in the coming 30 days. The VIX index is calculated using a very wide range of S&P 500 options, both calls and puts, which have more than 23 days and less than 37 days to the Friday expirations. Unlike the old VIX, if you are aware of that, which is based on the S&P 100 at the money options, both skewed and smiles are included. The index calculations does not require a pricing model. Instead, it is based directly on option prices. Below is the main formula that helps you do the math. I'm not going to dig into the details, but for those who are interested, you can refer to the white paper on the SIBO website. So let's continue. So on the left-hand side is the VIX index for the past 16 years. The average index level is around 19, but it can go to as high as 80 and go to as low as 10. From the chart, you can spot some characteristics of the VIX index or the implied volatilities in general. Firstly, the implied volatility mean reverts to its long-term mean. It spikes quickly during the market uncertainty and takes a much longer time to calm down after it. And it does cluster, which means that high volatility regime is likely to be followed by high volatility regime and likewise. Besides, historically speaking, the spike in the VIX index coincides with the trials of the market. So it can also be used as a reference or for the timing tool. For instance, if the VIX index is above 95th percentile over the last 3 months, one can consider buying the dip. According to many researchers, the implied volatilities overestimates the future realized volatility. As a comprehensive single value representation of the implied volatility, the VIX index also estimates the future realized volatility. The premium on average is about 3%. Now let's take a look at the scatter plot. On the horizontal line is the daily S&P index movements, returns. On the horizontal or on the vertical index axis, it's the VIX index daily returns. From the chart, one can very easily figure out that those two indexes are negatively correlated. And if we further divide this data set into 4 different categories in terms of S&P 500 daily return brackets, for example, this one. This one displays a relationship between S&P index and VIX index when S&P index daily movement is between 1 and 2 standard deviations. One will see that the bigger the daily movement of S&P 500 index, the more negatively correlated it is to the VIX index. And the VIX index goes up more quickly in the downward market than it goes down in up market. This convexity characteristics makes hedging market portfolio with VIX related products very effective. But there is a catch here. Although we have mentioned that these two indexes are negatively correlated, there are about 20% of time where they both move in the same direction. So this chart is dividing daily VIX index returns by the daily S&P index return. So on the right hand side of the chart, you see some positive numbers. This means that they move in the same directions. So there are around 80% of time they move in the same direction, and for 20% of the time they move in the 80% in the different directions. So consequently, so this means that when S&P 500 index goes up, the VIX index goes up as well, and vice versa. Consequently, you make extra money when the market goes up, and your loss is exaggerated when the market goes down. When this happens, you should pay extra attention. The fact that the implied volatility goes up with the equity index may imply that the market participants are worried about the future direction of the market, and it may mean that the market is close to a local peak. On the other hand, if the VIX index goes lower while the market edges lower, it can be a sign that the uncertainty of the market is lower and bad news has been digested and the market is probably reaching a local bottom. Okay, we've just quickly covered some background information about VIX Index and its general relationship with S&P 500 Index. Now let's see what are available for us to trade. One very important thing to point out, before trading VIX related products, you need to understand that those products are complicated and have payoffs that are very different from other products. As some of the products are derived several times from its origin, you need to make sure that you do know what you are trading. The chart here briefly explains the flow. We will go into details on some of the text boxes in later slides. The arrow in the slide means that the right-hand side is derived from the left-hand side. Starting from the S&P 500 index, we have got the S&P 500 index options and then the VIX futures. We have both futures and options available on the VIX index. As for VIX future, it is the world's most liquid volatility future. It has a contract size of about 1,000 US dollar vega, which means that a change of one volatility point leads to a 1,000 US dollar profit or loss. Recently, Cboe listed the mini VIX future that lowered the threshold for trading. At 1/10 of the standard VIX future contract size, it provides additional flexibility in volatility risk management and a greater precision in trading. Simply put, VIX future gives you a way to express the view in future volatility in a pure and uncontaminated way. Unlike option portfolios, after you put on the trade in the VIX future, no dynamic hedging is necessary anymore. And the final payoff does not depend on the equity index level. Then there are other listed ETP or exchange traded products. Some are ETFs that have a direct holding in VIX futures, and others are calculated based on a formula and backed by an issuer. Many things happened in this sector in the past 3 years, which led to the liquidation of many ETPs. And derived from ETP, we have ETP options. And besides, Cboe disseminates prices for many tactical indexes. And then from that, we have indexes that combine both an equity position and a VIX tactical index. Finally, there is a VIX Index, which uses the same methodology as the VIX Index, but applies the calculation to the VIX options. Please take a short moment. Let's think about what actually does the VIX Index measures. It actually measures the expected volatility of the 30-day forward price for the VIX Index. And the VIX Index in itself is an expectation of future 30-day volatility for the S&P 500 Index. On the bottom right on this chart, I put the time series of this index for information if you are interested. So in the next couple of slides, we will discuss the characteristics of VIX future, as it is the root for most of the related indexes, ETPs, or strategies. The VIX future has an upward sloping curve, or more precisely, being in contango for more than 80% of time. Let me find my mouse here. So whenever we say the prices are in contango, it means that the future prices are higher than spot price. And as time goes by, it will gradually converge to the spot level. So if you hold a long-term position in futures that have a contango term structure, you will incur extra loss due to such convergence. On average, the first month's VIX future is 0.5 points higher than the VIX index, and the second month's VIX future is about 0.8 point higher than the first month's future. In short, VIX futures prices overestimates the VIX index. Here are two graphs of VIX futures in two very different term structure shapes. The one on the left was taken on the 16th of March last year, when the market experienced several sessions of serious sell-off. The right-hand side was taken on the 30th of April this year, which is what in most of the days the term structure looks like. Apart from knowing some extreme values of the VIX index, one important thing should be pointed out. You cannot get a replica of a VIX index performance by just trading VIX futures. And the change of VIX futures prices are less volatile and has a smaller range than the spot VIX index, and the sensitivity of the VIX future price to spot VIX index changes is lower for longer dated futures. For instance, in this chart, the difference between the first VIX futures is more than 40 volatility points. And for the seventh, the difference between the seventh VIX futures is less than 10. When you trade VIX futures, you should be very careful in choosing the right expiration to trade. As the rule of thumb, your choice of futures should match the time frame of expectation. If you think the volatility is going to spike within a month, it's better off taking a long position in the first or second active futures. Finally, the applications. So I would like to discuss 4 main applications using VIX futures or related products from the manager's perspective. The first one, pure directional play on volatility. Then the premium harvest strategy to hedge long equity exposure and to do pair trading with other volatility futures. The first one, or pure direction play on volatility, is very easy to understand. If you build up an expectation of the direction of the volatility while the current market price is not yet reflecting such an expectation, you might take outright position in the futures with the desired expiration, or to save your effort in regularly rolling your future positions as they get expired. You can gain either long or short exposure by trading ETPs. This is a table that summarizes the current major ETPs around the world. They combined hold a very significant amount of the open interest in the first 2 active VIX futures. Most of them have the normal long exposure, except for UVXY, the second one, the UVXY, and the third one, the SVXY. The UVXY has a 1.5 times leverage, and SVXY has a minus 0.5 times leverage. It sounds unusual that some products have a leverage in half times. True, it did not start it like this. UVXY used to be a 2 times leveraged ETF, while SVXY and 1 time inverse ETF. The major reason for this is that during the first quarter of 2018 and 2020, the market experienced an extremely high level of volatility movement, and that led to a spike of several 100% of long volatility exposure ETF and almost wiped out all the value of some of the ETFs with short volatility exposure. Take XIV as an example. XIV is a 1-time inverse ETF. During the first week of February in 2018, the VIX index spiked from 13.47 to 37.46, causing the ETF price to collapse from almost around 130 to 5.1, or equivalent to a 95% drop. Later, the ETF got liquidated, and more ETF got liquidated in the subsequent years. So if you take a long-term position in the inverse volatility, you might encounter some black swan events like this one. But if you take a long position in this volatility ETF, you also have problems. So for example, you take a long position in the ETF called VXX, the first one, and the one with the biggest AUM currently. The underlying index for the ETF is SPVXSTR. In the long run, it costs you around 45% a year to hold it. I will talk more about the index so that we know where does this 45% annual loss come from. For now, you just need to know that you're not suggested to take a long-term position in those ETFs. Their expected value in the long term can be 0. Now I'll try to explain the strategy of premium harvesting by introducing you 2 of the tactical index. The first one is the SIBO VPD Index, and the second one is SPVXSTR Index. So VPD Index is actually tracks a systematic short first month VIX future volatility. It is calculated on a daily daily close, and it hold solely short positions in the first month's VIX future. And on each expiration day, it rolls its position from the current month to the next month. It sets its trading size in such a way that if the VIX future goes up 25 points, the loss from the movement is equal to or less than 25% of the fund value. So from the chart, you can see that generally speaking, this strategy is actually a reasonable one as it goes up generally, but once in a while, you will incur very serious loss. So again, it is not suggested to take a very long-term position on this kind of index. The second one is SPVXSTR. It's actually also a strategic index. Different from the first, the previous one, actually, the previous one, VPD holds a short position. This one holds long position in VIX futures. And it holds both first month and second month VIX futures and adjusted daily. It has a target. It targets weighted expirations of 30 days. So in a normal portfolio, you have two futures. One future has expirations less than 30 days and one longer than 30 days. You will need to dynamically rebalance it on a daily basis. So, and this index on the chart you see, it loses around 45% every year on average. There are three sources of losses. The first one is because the VIX future in most of the times in contango shape, so it's higher than the VIX spot index. So you are buying some futures that has premium compared to its underlying. So in the long run, you lose money. And by targeting a weighted expiration of 30 days, you need to sell a little bit of your front month position and buy a little bit of a second month VIX futures. So you're actually, as the curve is mostly in a upward slope, you're actually buying something that are more expensive and selling something that are cheaper. And the third one is called the volatility drag. It can be best explained by the very simple example, because the SPVXSTR tracks the daily returns. So for example, there is an index, it starts with 100. If the index then goes up 10% and goes down 10%, it ends up in 99, so which is 110 times 0.9. But if the index goes up 20% and then goes down 20%, it results in 96. So it's like 120 times 0.8. So in this way, it means that the more volatile VIX future is, the more obvious this volatility drag effect will be on this SPVXSTR index. So the three factors combined. So in the long run, this index just goes down. And as the VIX future, a VXX ETF tracks this index, so over the long run, that's the reason why it loses almost 45% on each year. And it is not a good idea to take a long-term position in those VIX futures. For those, there are people asking, how can I, if the VIX index is so mean reverting, is it the case that when it's low I buy it, or is this and then I sell it when it's high? It is not that straightforward, because VIX index is not an index that is directly investable. And even if with this SPVXSTR index, it does not track VIX index well in the long run. You see on the right hand side, the VIX index is very mean reverting with a range from 10 to 80, but on the right hand side, the indexes go down in one way. So in the long run, if you hold the long-term position, either you will bleed your P&L away in the long term for long exposure, or you possibly get ruined by taking a short position when the market suddenly goes crazy overnight. So now there is a dilemma. You cannot hold the long-term position in this kind of products, and if you go short, even if you have 45% annualized returns in the long run, but sometimes you can incur several 100% of losses. So what do we do? So here is like a modified version of this strategy that's also based on VIX future time structure. And this strategy is an intraday strategy that uses VXX US equity as the underlying. So every market open, the strategy checks the below. Whether the first one is whether the VIX index is smaller than a constant times VIX 3 months index. VIX 3 months is like a median term version of VIX index. The second question is whether VIX index is lower than a 30-day moving average of VIX index. If the answer to both conditions is true, okay, we open and short position at open, and otherwise we do nothing. And once you have a position, you have short position at the open, and if the mark-to-market loss is bigger than a threshold during the continuous session, you stop loss. Otherwise, you flat the position at the end of the day. So in this like analysis, we will keep a fixed trading size each time at $1 million US. So on the right hand side, it's like P&L curve for such a strategy from the inception of the VXX ETF up to last month. You will see that even though the return is much less than the 45%, but you don't have the problem of being wiped out completely in one or several sessions. Okay, then the third one is hedging long equity exposures. Actually, this topic is very flexible. I mean, everyone has its way of hedging using VIX related products, some using futures, some using options, some use a very static way of hedging, and some like uses a pretty dynamic ones. So I have one example for each. On the right hand side, it's more a kind of a static hedge. So I use both indexes. So I do not really need to go into specific about each a specific volatility fund. The left hand side is that you combine 95% of SPX index and invest 10% of your notional into a SPVXSTR index. So from the chart on the left hand chart, you can see that it does lowers the drawdown in the short run, but at the cost of the longer term net return. So whether this is a desirable consequences, it's up to everyone's judgment. And on the right hand side, it's more a dynamic one. It's called a VXTH index or SIBO VIX tail hedge index. So what does this do? This has a base position of S&P 500, and you invest a small portions of your notional into a delta, the front month's VIX index calls, or to be more precise, a delta 30 call. So the basic rules is that if the forward price of VIX index is below 15%, you do nothing. Same for when the forward price is higher than 50. So if the forward price of the VIX index is between 15% and 30%, you invest 1% of your total notional into the VIX calls. And if the forward price of VIX index is between 30% to 50%, you invest around 0.5% of your total notional. So, and this results in this is the on the right hand side is I'll say the index for this one. So because you are always constantly paying to buy protection, so most of the time compared to a normal S&P index, it underperforms. But also you should not be also misled by this chart where there is a very big increase on the right hand side. It's because earlier last year in March of 2020, the volatility goes up so quickly that those payoff on the VIX calls are like several times. This returns, sometimes you need to take a second thought, a deeper thought into whether this kind of return can be replicated as as I just mentioned. So if the volatility stays between 15% and 30%, and you have a call option, and then the market goes up, true, you can have a very good return because the volatility goes up a lot, and you have invested 1% of your notional into it. But if volatility goes from 14%, goes from something below 15% directly to maybe 30, 40, 50%, actually you do not get hedged. So this kind of a strategy, the payoff of this kind of tactical index is past dependent. What happened in the past should not be taken for granted for what's happening in the future. So the fourth one is to trade a spread trading strategy with other volatility futures. So in this example, I'm using the VSTOXX. VSTOXX is the volatility future for the flagship Euro Stoxx 50 indexes. And this is the most heavily traded volatility stocks in Europe. But relatively speaking, the liquidity is quite low compared to the VIX futures. So here are two charts. Left-hand side is the spread between the VIX index and the V2X index. The index for VSTOXX. And from the chart, you can see that the correlation of these two is quite high at 0.87, and the difference between those two indices are quite mean reverting. So the low and generally speaking, VIX index is lower than a V2X index, and it's most of the time the VIX is cheaper. Sometimes can be as cheap as like minus 15 points. And on the right hand side, it's the same chart, but you expressed using two different volatility futures. So the chart is prepared by using the front month's VIX futures and the front month's VSTOXX futures. As several slides earlier, the VIX future is actually more mean reverting than the VIX index. So if you combine two more mean reverting products, you will get more mean reverting like graphs. So this is on the right hand side. This is one way you can like trade or make profit. So what you're going to do is you can form a quantitative expectation of what the fair value of the spread is. Then based on that, if it's too cheap, you buy it. If it's too expensive, then they sell it. Of course, in most of the times, you cannot very rigidly for quantitative analysis, because there can be something new happens in the market. And this one, it's a different perspective of looking into this strategy. So this chart is called the basis spread between the VIX M1 future and the V2X M1 future. What is the basis? So for those who are not very familiar with this concept, the basis is the difference between the future and the spot index. For example, if the VIX future front month future is 24 and the VIX index is currently at 20, so the basis difference is the basis like 4. And for the V2X at the same time, the V2 index reading is 30, and if the future is 36, so the basis is 6, and the basis spread in this case is 4 minus 6 is minus 2. So because as time approaches more to the expirations, the future will converge to the spot. So the basis is bounded to converge to 0. So this basis spread is a way more mean reverting time series than the previous one. The previous one is can have a negative mean and non-zero mean. But for this one, because both futures will converge to the index in the end, so this one is very mean reverting. So again, for this kind of mean reverting charts, when it is low, you buy; when it's high, you sell. But there is one thing you need to pay extra attention. If you trade on this right hand side of the right-hand side graph, the P&L is very easy to explain. So for example, if you take a position at -10 and the index goes, if the spread goes down to -15, you lose 5. If then the spread goes back up from -10 to -5, you make 5. But for this one, if you buy at -5 and later on you manage to sell it at 0, your P&L is not necessarily 0, because there is one factor that you have not hedged away during this trade, which is the spot index. So when you long spread on a basis spread, you do not only trade the absolute level of the future, you also take an implicit spread position in the spot indexes. So these are the 4 main applications I would like to introduce to you today, but that is more from like asset managers point of view. But actually there are other applications, like for example market making, where you can post a two-side quote based on the theoretical price, or the second one, the term structure trading. So by looking to historical data, so you kind of have a concept what a normal term structure should look like. Then if the market, what's implied in the market is different from what your research tells you, then you can trade, you can build up your positions in long-short positions in different expirations. Like for example, if currently the time structure is very steep, too steep in your view, then you can buy futures in a shorter dated build up positions in the shorter dated futures and sell on the longer dated ones and hoping it to come back. And third one is the standard VIX future versus mini VIX future arbitrage. All these 3 applications is not really for fund managers, because and more for proprietary trading firms, because it does require some much better like technical infrastructure setup, and also I would say it's not really for retail investors, as for example with the third one, standard VIX future and the mini VIX future arbitrage, the concept itself is straightforward. So because both of the contracts is going to settle using the same settlement price. So if two futures traded with the different prices, you just long the more expensive one and sell the cheaper one, and then you just wait for it to expire. But the biggest challenge here is how you manage to build up this kind of positions. In most of times, because the market is so competitive, by just crossing the market, most of the time you cannot make money. But if you really try to join the market, if you send limit orders to the order book and try to get hit or lifted and then hedge with the other ones, sometimes because maybe your speed is not very fast or your algorithm is some like flaw, sometimes you will be actually arbitraged by other competitors who have a better like technological setup or have a better like expectation of the future. So this is more or less I would like to talk about today. And now if you have questions, I'm very happy to address it.
Hey Richard, we have some questions. The first one is from Kenneth. He's asking, what's the risk to look out for in VIX and how best to mitigate big losses if the bet went the other way?
And can you repeat the first half?
All right, the first part is, what is the risk to look out for in VIX and how best to mitigate big losses if the bet went the other way?
I mean, the risks in the VIX futures, I will say, I think I've mentioned that, but I can repeat it here. So, generally speaking, you're not suggested to take a very long term, because if you take long positions over the long run, you bleed almost to zero. But if you take short positions, then once in a while you will have a very big loss. Like I personally used to trade a very small one. So for example, if you sold something at a volatility 14, then if you trade futures, this is one thing. So if futures you sell at 14, then you like last year from 14, 15 very quickly in 1 week, I think, spikes to more than 70. So you lost 60 volatility points in one VIX future, which translates into 60 times 1,000, like 60,000 US dollar just for one future. But if you trade those like volatility ETF, the situation is even worse. Why? Because the payoff in the volatility ETF is based on returns. So for example, if you sell at 14 and you end up 17, so actually you lost 400% extra percent. So how to mitigate this kind of risk? First, if you only have this, if you trade this kind of a product separately, it is not a good idea to always keep short. So you have entered into this kind of dilemma, like we also have it like within company here. So if you want to say, if you want to keep short position, if you trade too small, say you have a fund of like 100 and you know that you're prepared for this risk, then you're saying, okay, the thing is going to explode maybe 400%. Then if I only willing to take a 5% hit in the fund, so you can only say trade, so 400% and 5%, you can only trade maybe like 80 times, 180s. So maybe you spend, then you invest, you keep short 5%, 2% of your, keep a position of 2 in the fund. And then every year you only make 1%. But if you take too big of short position, say if you take like 10% of the fund, then sometimes it's just your loss will amount to maybe 40–50% in a very short time. So how to do that? First, do not always keep short, especially at a very low level. And the second one, you maybe start only to go short when the index is like at some higher level. So for example, if the volatility is lower than the maybe mean, you can define a window of your preference. Say maybe you look back 3 months or look back 6 months. If you say if your volatility is lower than 90% or maybe 95%, you don't go short. And also, if the volatility is at, this is relatively speaking, if the volatility number is too low, say maybe below 20, you don't go short. Only if you see a volatility has a spike, then you start to go short. And the other thing that if you can have another strategies that have a different, that opposite payoff with like this, like for example, for some of the proprietary trading firms, because the more volatile the market is, they are the more profitable it is. So they will say, okay, if I have a strategy and it makes a lot of money when the market is volatile, then I can combine this with the short volatility ETF strategy, so that you can, when the bad things happens, you're compensated by the other strategies. So over the long run, the risk management of this, the topic of risk management regarding this VIX future or volatility future is not that straightforward. It can be quite difficult, but for individual investors, I would say it's not really a good idea, especially like for example, I mentioned the UVXY now is 1.5 times leverage. Couple of years ago is 2 times leverage. So if you sell something like this and the volatility spikes up like 10 times or maybe 5 times, and your loss is like 1000%, which is like far from being bearable. And that's my answer.
All right, thank you, Richard. Would you be okay amongst what you've covered today, based on the strategies that you've shared with us? What would you think is the ideal strategy for someone new to VIX to consider?
For someone new, I would say the most easy way is of course to hedging, right? Because the convex characteristics, if you already have an equity position, then you can hedge. The other one, like the VXTH, you can also think about it. So for example, you already have a equity position and you dynamically invest part of your portfolio in a VIX future strategy, VIX option strategies. But if you want to trade it like as a separate strategy, I would say I've mentioned one, which is actually intraday strategy. So every open, you look into the market. If the market is in contango, which means that it's still quite the market is still quite in a quite calm state, then you take a short position. And if the market goes up after you take a short position, you cut loss at some point. Otherwise, you just keep the short position in the end. I think this one for individual for someone new to this one, I don't think someone new to this is really very suitable for this kind of product. But I would say try to only take intraday positions. I think this is the most important things regarding risk management if you are just new to this market. Because if you take a longer term positions, the odds are against you. Either you take a long or you take a short if you want to trade it separately.
All right. So based on what you've shared, it's more like more suitable for trading intraday or very short term.
Yes, I'll say it's more for speculative trading. This is absolutely not something for investment.
Richard, while we wait for the rest of the questions, if dear audience, if you have questions for Richard, please type them into the question box and we'll pick them up shortly. Richard, meanwhile, while we are waiting for the questions, based on what you've covered today with regards to real life examples of trading the VIX and Mini VIX, what do you think what would be the 3 takeaways for the audience? You know, like if there's anything they'll remember from this session, what would be the 3 things they should remember?
Yeah, 3 things. I would say what covered today is not actually what I'm trying to say is more about the characteristics. You need to keep in mind what is implied volatility about. So first, several sentences is okay. It mean reverts. It spikes fast, goes down lower. This is one. Starting from that, then you have VIX futures. What does VIX future looks like? Most of the time is in contango. So for anything that's in contango, when you take long position, you lose money. And the third things, VIX future and all the products related is actually a very derived product. You just think of it. So VIX future, I'll say the VIX, the SPVXSTR index is a portfolio of VIX futures, and the VIX futures is derived from VIX index, and the VIX index is from the VIX option, VIX S&P options, and then options in from the index. So if you the payoff of all these VIX futures of volatility ETF is very different from the stocks. And the last one is if you are new to this, or if you do not have strategies or positions that has an offsetting payoff, just do not take longer term positions and try to use this as a very effective way of expressing your view. And so, for example, if you think there are something that bad happens in the future, or say maybe tomorrow there's going to be some like a data, or tomorrow maybe some president is going to say something, and the market seems to be very calm, and you say, okay, I want to take a position just for a bet. You need to keep your bet small, and once your expectations is either realized or not realized, you need to stop loss. Do not stick to a position if it does not go as expected.
Richard, so since you mentioned that, you know, like if there's potentially a market event that's going to happen, and you have a view that it's potentially going to move the VIX, since you touched on that, what would be the key events that traders should look at the VIX? Like when those events are upcoming, what kind of events should we look at the VIX when the event is just around the corner?
Yeah, I mean, in the past 1 year, so the COVID number around worldwide. So now, for example, recently the Taiwan SE, the Taiwan index went down quite a lot, and it's because that they find a many more new COVID cases, and for India, and also, like for example, if the cases in the United States is going back up, then definitely the volatility is going to go up, and also whether the Fed is going to keep the interest low, when and where and how much they're going to modify the interest rate, and also I would say the relationship between China, between the European countries, and China and in United States. So all this kind of like country like bilateral, multilateral, like country level relationship, the COVID cases, and also the interest rate policies, this kind of things all can potentially have a very big influence on the VIX index, and that kind of influence, when it comes, is actually almost instant. So when volatility goes up, when bad news comes, it's the index spikes immediately. So in this sense, it is not something that you can like stocks. So like stocks, you can do say, hey, if the price is cheap, then I can buy into it and wait until it goes up. But for volatility products, you do not have that luxury. So you have to be quite accurate. But to have this sense of to have this level market sense is not very easy. So like in the bigger company, so in our company, we have people to look into the fundamentals, like monitor the key indicators, and also we also try to look into the real trends that is going on in the market. So for example, what is the trend structure today compared to 1 week ago, like 1 month ago? And also in like for example in S&P 500 index, which strikes is most heavily traded, and also for the VIX futures, there are in the past several years, there is always if you look into the news, there is always someone that comes in with a very big buy order on upside cost. Like last year, it paid off a big time, and this year, so far nothing happened, but who knows?
All right, Richard. So what you're sharing is when there's a market event that potentially can move the VIX, it takes place very fast, and you can't sit back and wait, just like what we normally do when we trade stocks. So we have an understanding of the market events can potentially move the VIX. So VIX being a contract, I mean, you've touched on this earlier on. What actually makes up the VIX, or what does it follow, or what is it packed against?
I mean, the VIX futures or the VIX indexes?
The VIX futures.
The VIX futures. VIX futures actually. VIX futures. I mean, interrupt me if I does not understand the question correctly. So the VIX futures actually are some expectations of VIX index in the future. So it's still have its origin in the VIX index. Is actually so some expectation of the expectation. So what's the implied volatility will be like into the future is still in its essence. So to have an estimate about the stability or uncertainty of the future market state. So in normal cases, it's like the VIX futures in upward sloping. This means that, okay, what if the market is currently quite calm? They will say, okay, it's quite calm, but the market cannot be always like calm. So the current the front month VIX futures is low, and then the longer dated futures is more upward sloping. It's higher, but if the really something very bad happened, so the term structure will be like downward sloping. that's one of the reasons that, okay, the market is so bad, well, it's so high, it cannot be that bad, forever. So the future will be in a calmer state. So I would say VIX future is not really backed by some, I would say, the real asset, but it's actually backed by some an expectation, I would say a consensus. And as one of the topic today, so VIX futures or volatility as an asset class, if you trade this kind of thing, it offers a very different kind of return profiles. So you can increase your return and increase return without increase a lot of risk if you diversified some of your money into this kind of a VIX future or volatility kind of strategies.
Richard, now that you're talking about returns, apart from returns from trading the VIX, are there any other reasons for why you think traders should take a closer look at the VIX and why the opportunities in the VIX is worth looking at?
Okay, first, VIX future offers you a very clean exposure to volatility. Before VIX futures, now VIX futures actually is still quite new thing. It started like I think something like 2003 or 2004. First, it is a very clean contrast to play with volatility. In the past, when we need to trade volatility, we need to trade options. So, but with options, there is so many more factors that are having influence on the final payoff. And the other things, the VIX future, why should we trade the VIX future? And also, yes, the VIX future, the volatility of VIX futures is very high. So once there is volatility, there are opportunities. So it's especially, so it is easy to understand. So if you are trading something that only moves like 1% in a year, there's not much to be made. But if you are trading on something that is like high low can be 100 or 200%, there are so many more opportunities in the market. And also, so if the something is very very calm, you really need to make a very correct call. So for example, if the stock is trading between 100 and 101, how can you make money? So by buying 100 and go to 101. But for the same example, if something fluctuates between 100 and 200 and like a bouncing ball, like maybe 100 times in a week, then it kinds of making a correct call less important. So for example, if you sell 150, so it goes down 100, goes up and goes down and goes up. So in the end, the total profit, I'm saying generically speaking, the profit comes from two sources. The first, coming from taking a very correct position. So you have a view and you're correct, they make money. The other one is coming from trading. So the more volatile it is, the more trading opportunities, and the more volatile is, sometimes the less efficient the market is. So if the market is not liquid, very calm, normally it's more efficient. But if the market is very quick or very volatile, and many people are trading it, and especially the volatility of this can be influenced by some unforeseeable events. The opportunities is like everywhere.
All right, thank you so much, Richard. Richard is the Director of Research Department for Legend Art Financial Group Limited. Thank you so much for your time and walking us through the real-world applications of the VIX and Mini VIX futures.
Thank you. Thanks for having me. Thank you.
Thank you so much, Richard. And for our wonderful audience, thanks for tuning in. Till our next live webinar, stay safe and take care. Do look out for our follow-up email, which will be sent to you tomorrow, and you'll have a link to the recording so you can catch up with what was shared by Richard. All right, take care and good night, everybody.
Good night.